We're looking at the Sodgrass and Flamini case study here. Let's scroll down and start reading question 1, and then we'll hop into the vignette. Question 1. Which of the following comments as made by Snodgrass are correct? Comment 2 only, comment 1 only, or all 3 comments are correct? So it looks like we've got our 3 comments right here, but let's start reading from the top. Mike Snodgrass and James Flamini work as private employee pension consultants. They have established a partnership under which they jointly offer investment advice to companies on pension schemes, management, and financial reporting requirements. During a conversation with a potential client, Snodgrass made the following comments. Comment 1. In a defined contribution scheme, the employee bears the risk that the plan's assets will not be sufficient to meet future obligations. This is a correct statement so far. In a defined contribution scheme, this is something like a 401k plan in the United States, where the plan is essentially providing investment options for the employee, and then the employee contributes their money and decides which funds to invest in. Second part here, the impact on the company's defined contribution pension plan's financial statements is easily assessed because the company has no obligations beyond the required contributions. This is also a correct statement. They have no obligation beyond those required contributions, which is typically something like a percentage of a 401k match, which is a certain percentage of the employee's income or whatever they contribute. So comment 1 looks like it's correct so far. So looking at our answers here, we can go ahead and cross off A, comment 2 only, since it doesn't include comment 1. So we're either going to have B, comment 1 only, or C, all 3 comments are correct. So let's look at comment 2. Under IFRS, the pension obligation is defined as the present value, after deducting any plan assets, of expected future payments required to settle the obligation arising from employee service in the current and prior periods. So this is pretty tough because it's basically just a definition, but essentially this word after is supposed to be without deducting, and so that makes this whole comment incorrect. So comment 2 is not correct. So looking at these then, we can probably cross off C and go with B, but let's read comment number 3 anyway, just to make sure that affirms our answer. If a plan's funded status is negative, it means the fair value of the plan's assets exceed the present value of the benefit obligation. This is going to be an incorrect statement. If the plan's assets are greater than the obligation, the funded status is going to be positive. Funded status is going to be assets minus liabilities. So that said, we can conclude 3 is also incorrect and confidently go with answer B, comment 1 only. Question 2. In the current financial year, ABC will report a pension asset or liability amounting to $545,000, $105,000, or $410,000. So we left off after comment C, so we'll start right here reading. ABC is one of the companies that have sought investment advice from Snodgrass. The present value of the company's defined benefit obligation is $23,445,000. The plan's assets amount to $23,990,000. Furthermore, the available future refunds and reductions in future contributions currently have a present value of $410,000. So notice that number is lines up correct or exactly with C. So it looks like we have enough information here to answer this, since we're looking at the asset or liability, and we have that asset versus liability number. So A is simply that $540,000 is basically just taking our asset minus our liability. But the problem is this isn't taking into account the future and present value numbers. So it kind of gives us that answer right there in the next sentence there. So furthermore, available future refunds and reductions in future contributions currently have a present value of $410,000. So this is basically telling us that the difference between the assets and the liabilities minus these available refunds and reductions is leaving us with $410,000, which is our answer C. So it's looking like we'll cross off A and we'll go with C here, that $410,000, since that takes into account the present value. Not that it takes into account the present value, that it takes into account those future refunds and reductions in the future contributions. This $105,000 number, I'm not really sure where that comes from. So we'll stick with answer C. All right, question 3. ABC's interest cost / net interest expense at the end of year 3 in regards to its director is closest to. So we left off at this 410,000 number, so we'll start reading at the director, which looks like that's what we're looking for anyway. The director of ABC is entitled to a retirement benefit of 10% of his final salary per annum for his contractual period of 3 years. So this first sentence, he's getting, for a 3-year period, he gets 10% of his final year salary. His expected salary over the next 3 years is $200,000 in year 1, $240,000 in year 2, and $264,000 in year 3. So this is that final salary that we'll be using to kind of for this calculation. The company assumes a discount rate of 5%. After comprehensive consultations, ABC decided to improve. Okay, looks like this isn't relevant, so everything that we need is in this paragraph here. So let's start by bringing in the table from the answer online, and we'll kind of start walking through how to solve this. So what we need to first figure out in this question is we need to know what our current service cost is going to be. So our current service cost is going to be that 10% final salary per annum. So we have his salary for each year in here, but the 3 years and beyond, after he retires, basically he's going to be, the service cost is that $26,400 number that he's going to be receiving. So this is basically the nominal amount that he'll be receiving those 3 years for a total of $79,200. So basically we need to take this and discount it back to the present value based on today's dollars, since we're not yet in year 1, since the anticipated salary of year 1 is $200,000. So what we're basically going to do here is this 23,945 number. It's imputed by discounting 26,400 back 2 years using that discount rate of 5%. So I'm going to pull in another table of the kind of how each of these numbers here is calculated, and then we can talk about that. All right, so we've got our current service costs, $26,400. To get to that 23,945 number, we're going to be discounting back for 2 years, like we mentioned, the 26,400 number. And then to get this 25,142, we're just discounting back 1 year, since this is in year 2. So then next, the interest cost, which is going to be 5% times the liability, since that's the discount rate of 5%. So the tricky part here is we're using, this number is derived by 23,945 times 5%, since that's liability. And then in year 3, it's going to be both these numbers added together and then multiplied by that 5% liability to get you to that, to this number here, the 2454. Which we can see here. So we've got those two numbers multiplied by 0.05 gives us to 2454. And then that one number multiplied by the 5% gets us there. And then for this last column, these two numbers are just added up to give us that 3651. So when we do that, we see that we'll go with answer B. All right, question 4. Following the change in service life assumption, how should ABC's increased pension liability be treated in financial statements? So let's see here. We left off at this last paragraph, so not much more reading to do. After comprehensive consultations, ABC decided to improve its defined benefit pension scheme under the new arrangement 60 years of service as opposed to the current 80 years. So we're changing our assumption from 60 years down to 80 years. Will be referenced to determine the benefit payable. Following the changes, the defined benefit scheme liability is expected to increase by $10 million. That is expected. Employees at the company have an average remaining service life of 10 years. So we've got this change in the number of service years, and we need to figure out how it's going to affect the financial statements. So the past service costs should be spread over the remaining working lives of the employees. B, the past service costs should be charged against retained earnings. Or C, the past service costs should be charged against profit or loss for the year. So it's basically kind of, we need to figure out where this $10 million is going to go. And one of the other keys here is that they're reporting, I think it said it somewhere up here, right here. So they're reporting under IFRS. And so the rules under IFRS is that the past service costs, including past and current service costs, are recognized as expenses on the P&L. So that being said, we will go with answer C.